Okay, this is the money market with investment demand. You have a vertical money supply. You have a downward sloping money demand. Where those two things meet gives you the nominal interest rate. Now we have investment demand over on this side. It's a downward sloping curve as well. And our money supply, our quantity of money. So the nominal interest rate is the price tag of money itself. So that's the lowercase I with the percent. The money supply is vertical because the Federal Reserve Bank has a monopoly on it. So at this point right here, we have the cost of lending money or what pays in your savings account. Okay, that cost, that's MD for money demand, QM for the quantity of money, M for the amount of money that's available at the moment. So we're going to take this and bounce it off or reflect it off of the investment demand curve. So we have a certain level of investment at this nominal interest rate. Okay. Now in this particular case, what we'll look at is money demand and what it's going to do. So remember, there's two types of money demand. You have asset demand or transaction demand. So if either of those two things are needed, then what you're going to end up doing is shifting money demand to the right or the left. So if money demand increases or decreases, that would change the nominal interest rate, and therefore that reflection would change of how much interest there is. So I know that this nominal interest rate is now reflected on the investment demand curve. So if money demand changes, let's say money demand increases. So if money demand increases, money supply is not going to change. So if money demand increases, it's going to shift to the right. And where it crosses, money supply is going to be at a higher level. So interest is going to increase. So if the nominal interest rate increases, what does that tell me? I drew this in red. So if interest rates go up, what is investment going to do? It's going to decrease. So I can reflect that right here. Over, it hits right here, it bounces down, it reflects. So now I can see, it's kind of like geometry. If you like geometry class and you had to prove things, right here's your proof. That's what we're doing with investment demand. Investment demand is all of the borrowers that are out in the market. So this is a movement on the curve. We have the same amount of borrowers out there. Now they're just going to borrow less because the interest rates went up. This is a contractionary thing. Okay? So the monetary rule, if the Federal Reserve Bank is paying attention, they would simply print more money and not let this happen. Okay? That would be how they stabilize the economy, by doing something like that. Now, if I want to look at what would happen if money demand were to decrease. If money demand, I'm going to draw these both on the same graph. You don't have to do that, or I don't advise doing it. It's just to show you what it looks like. So if we were doing the opposite, and money demand were to increase, say people are going to use less cash because they're using credit cards or something like that at Christmas, this would be money demand shifting to the left. And I can see where it crosses. The money supply is not moved. Federal Reserve Bank did nothing, simply money demand has decreased. Okay? So now I know where it crosses right there that interest rates would drop in that instance. So the nominal interest rate is going to decrease, and I drew this in green because it's expansionary, and at low interest, people will invest or borrow money and make capital purchases for the businesses. So I can reflect this off of the investment demand curve and see that with money demand decrease, interest rates drop, and investment will increase. So this is the money market with investment demand. These are my reflections of an increase or decrease in money demand itself.